Hey there, everyone. It's Leah Butler from Leah Sells Homes, powered by EXP. And today I want to do a quick lesson on, I guess, sort of conquering your fear because you're afraid of the lending terms and lending, just financing in itself. Some people have asked me, how do I know if I qualify for a loan? Okay, well, you don't know if you qualify for a loan until you actually fill out an application and try to see whether or not you qualify. That's pretty simple, because when you look at qualifying, I can't tell you if you qualify. I can say, oh yeah, sure, you make enough money, or you got low debt to income, but I don't know what else you're not telling me. And I don't need you lying to me because, you're the one who's buying a home and I'm trying to help you to get in it. So I need you to always tell the truth. So I'm gonna break it down to you like this. There are several different types of loans that you can actually use, right? And I'm gonna start here with an FHA loan. FHA loans are government-backed loans. What I mean by government-backed loans is the loans are actually backed by the government. The government's not giving you the loan. They're insuring the loan for you. But your lender, and I'm not a lender, so I want to make sure that that's clear. I'm your realtor. I'm the person who's going to get you your home, but you got to get qualified. All right. So look, the things that you have to do, your credit scores in itself with the FHA loan has to be 580, because that's FHA's minimum. 620. Now there are a lot of lenders that don't go below 620, so some of the loans are 620 in itself. You get a better rate if your loan is 660, and even better if it's 720 or more, right? That's what your interest rate will be better. So you have to have determine what your income is. With FHA, there are no income limits. Can you read that? No income limits. I wrote it all on the board because I wanted to be able to write it out so that you can understand it. So I'm gonna leave it here for you to be able to read it. It's probably backwards, but you cannot, there is no income limit in itself for FHA loans. So if you want to finance more than $472,030, you have to come up with the difference. But come on, how many people are borrowing, using an FHA to borrow $472,000? Most of the people that are borrowing FHAs, if they can afford that much of a home, they're putting more down on the down payment so that they can have less to finance over time. Well, still use an FHA loan, because because MIP in itself, yes, FHA has MIP, which is the same as PMI. They just call it something different, but they have MIP, and the MIP is for 30 years. Yes, that's what I said, 30 years. But who's going to stay in their first home or their second home for 30 years? Usually you have the stages of getting into a home. You might stay there 5 to 7 years unless you're really comfortable and you like the payment or whatever, and you want to stay there. You don't want to upgrade, but most people upgrade after 5 to 7 years. Lately, they've been doing it at 3, but who cares? Okay, so you want to get in, and then your first home ends at 7 years. And then you move to something else where you're having a family, get your husband, because, we kind of dominate this market. So you get your husband and start having kids, and, the house gets bigger, and you either need more room or you raise those kids and they go off to college or the military. And then you turn around and now you want to downsize because you don't want to clean all of that house, not by yourself. So then you turn around and you lower your, you downsize, you literally downsize so that you have a smaller home, a rancher, so you don't have to take the stairs. You're in a retirement community, so you don't have to keep the grandkids every weekend or 3-4 weeks out of a month. There's limitations to that. There's ways of getting around it. Anyway, if you didn't use an FHA loan, there are other loans that you can use. There's here in, Virginia, we have what's called a VHDA loan. That is not backed by the government. It is a private loan. Believe me when I say it is self-regulated, because the interest rates are a little bit higher. And they're starting to realize now that they are much higher than everyone else, and because they are private and they regulate it themselves and you pay them directly, in itself. So anyway, there's the USDA back loan. The USDA back loan is for rural areas, and there are limits to their loan. It's backed by the government. There's limits to the income, and there's limits to the debt that you can have. A lot of people don't. If you want like land, you want 1 to 4.9 acres, you can have that as your land for USDA. But you cannot have more than 5 acres for USDA unless you're what is it called? It's going to have to be like farming or something like if you're actual doing agricultural, then there's a different loan for that. It's still USDA, but it's backed by them. So with that, there's the conventional loan. A lot of people who have the money to be able to pay down on their initial down payment use conventional. Conventional has less stringent terms than FHA or USDA because they don't literally have the guidelines. They allow you to be able to even sometimes do repairs within your loan if you can qualify for it. And sometimes you have to do that because the house in itself may not be ready for what you're looking for, especially if you're trying to get a discount or something. Anyway, where I was at, using a conventional loan in itself requires 3%, 5%, 10%, or 20% down. They have less stringent terms for being able to qualify for them, and you can get you can get repairs and stuff like that, sometimes financed into your loan depending on the type of loan that you're trying to get. There's a lot of loans out here for you, but what I also didn't cover in FHA is FHA since February of 2023. Hey, okay, well, let's try to continue. When talking about FHA, I want to let you know that every FHA loan has MIP. MIP is mortgage insurance premium. Don't get it twisted. Don't let a lender tell you that, oh, you don't have to worry about your MIP. It does make a difference. And the reason it makes a difference because it's going to be on your loan for the next 30 years. Yes, it's going to stay for 30 years. No, you cannot get out from under it, even if you pay 20% down or what have you. No, you cannot get out from under it if you pay less than 20% down. You will be required to pay MIP regardless. However, the good thing is that recently, as of February 2023, the government has recently reduced your MIP, base points, which is calculated against the total of your loan, to determine as to how much you have to pay, from 0.85% to 0.55%. That's a huge difference for a lot of people. And being able, but like I said before, I'm not a lender. Talk to your lender. I'm just here to educate you because I'm your girl, your realtor advocate. So in itself, that's the big difference with MIP. But honestly, people don't keep a house for 30 years. They change the house in the average of 5 to 7 years. So you go from there. All right. Anyway, you have several options. You have FHA, USDA, VHDA, FHA, USDA, VHDA, and conventional lending. All in itself, but if you don't if you don't buy soon, you will be renting, and renting is 100%. And then you will be missing out. Regardless of how you look at it, even if you didn't buy your HGTV home, the first home that you buy, you can make it HGTV. Come on, we have Pinterest and House and YouTube and everything else. You make it your HGTV, or either that or you save enough money and being able to use FHA loan, getting into something that needs to be rehabbed, then you pay somebody to rehab it. It's still less expensive than if you were to pay for a ready-made moving home. It is what it is. All right. right. Anyway, when you first get your home, or before getting your home and you're trying to get your loan, okay, so when you're getting a home or getting a loan, I need you to do not change jobs in the middle of qualifying for a home, for a loan, qualifying for a loan. Do not buy or co-sign anything from anybody or for anybody or what have you. As a matter of fact, don't get a new car. Don't get any furniture. You don't need any furniture until you actually move in. And you want to make sure you move in first. And if you refinance your car, make sure it's what your lender, make sure it's something that your lender has you refinancing, right? So continue to reduce your debt to income in itself. And always, always call your girl, Leah, so I can help you out, all right? And I'll talk to you soon. Have a blessed one. Just know I'm here to help you change your future. Just contact me.